So imagine you wake up, you check your portfolio, and you see a position you opened exactly 1 year ago,
Right.
and it's up. But, like, not 10%. Not even 50%. Try 545.54%.
I mean, it genuinely breaks the brain a little bit. We just aren't wired to process that kind of, exponential gravity-defying surge.
Yeah, vertigo is, like, the perfect word for it. Because, while the S&P 500 has had this phenomenal run,
Oh, absolutely.
right, logging a 29.40% gain over the last year, but TTM Technologies Inc., or TTMI, has just utterly obliterated that benchmark.
It's in a completely different universe.
Exactly. And it just closed on Monday, April 13th, 2026,
Eh?
at $121.24. Along the way, tagging a brand new 52-week high of $123.16.
Which is wild, and that naturally brings up, I think, the most dangerous question in the modern market.
Yes, the big question for you listening right now. When a stock goes on a legendary run like this, is it, a screaming strong buy that is somehow still undervalued? Or are we looking at a classic retail trap just ready to plummet?
Right, the classic tension between market momentum and fundamental gravity.
Exactly. And resolving that tension is our mission for this deep dive. We are unpacking the financials, the technical charts, the insider moves, and, well, the whole bull versus bear case for TTMI.
We have to figure out what's actually powering the rocket.
We do. But really quickly, before we rip into the balance sheets, a quick favor. If you want more deep dives like this, you have to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave us a comment with your feedback. We want to know what you think of this stock.
And just a quick caveat before we pull apart these technicals. We are analyzing data and market mechanics today.
Right.
This is strictly an intellectual deep dive. It is not financial advice.
Perfect. So let's get right into it, the engine behind the rocket. You can't understand a 545% surge without, looking under the hood at the actual business.
You really can't.
So transitioning from that stock chart to the 2025 year-end financials.
Yeah, and if we look at the income statement, the top-line growth is extremely robust. Full year 2025 total revenue hit $2.91 billion.
Wow.
Right, which is up significantly from the $2.44 billion they pulled in during 2024.
So they are bringing in serious cash.
They are, but revenue is just the top line, right? The really impressive part is that net income more than tripled.
Wait, tripled?
Yeah, it went from $56.3 million in 2024 to a staggering $177.4 million in 2025.
That is massive.
It is, and that brings their diluted EPS up to $1.68.
Okay, those are incredibly robust numbers. And looking at the balance sheet, the foundation seems pretty sturdy too. Total assets are sitting at a healthy $3.84 billion.
Against what, roughly $2 billion in liabilities?
Yeah, $2 billion in total liabilities to be exact. With total debt carving out about $912 million of that, leaving them with, $1.76 billion in stockholders' equity.
Which is a highly defensible foundation.
Yeah.
They aren't drowning in debt.
Right. But okay, let's unpack this for a second because I want to play devil's advocate on the cash flow.
Sure.
The income looks great, but free cash flow plummeted. I mean, it dropped from $84 million in 2024 down to just $17.9 million in 2025.
That is a sharp drop, yeah.
Isn't a company bleeding cash like a car leaking oil on a road trip? I mean, that seems like a massive red flag.
Well, normally, yes, but you have to recontextualize that drop. It is not a leak. It's a strategic upgrade.
Okay, how so?
That massive cash drop to $17.9 million was entirely driven by heavy capital expenditure. Specifically, they are doing major plant expansions.
Okay.
Yeah, they are literally spending money to make money, reinvesting cash flows directly into physical infrastructure.
So the question isn't why are they spending the cash? The question is what exactly are they building to drive that kind of demand?
Exactly. What are the catalysts?
Right. Let's look at the bull versus bear business case. Because the stock is clearly on fire, but why?
Well, the bull case really comes down to the undeniable pull of AI. Their AI and data center revenue surged by an incredible 57% year over year.
57%. As the whole tech sector scrambles for AI server infrastructure.
Exactly. But it's not just commercial tech hype. They also just secured a massive $200 million contract from RTX.
Oh, wow, for defense projects.
Yeah, so you have that sticky, reliable government spending to smooth out the tech volatility.
That's a huge revenue floor.
It is. And on top of all that, the stock was recently added to the S&P MidCap 400 index.
Oh, which forces all those passive index funds to buy it mechanically.
Precisely. They have to buy it regardless of the price.
Okay, so that's the bull case. But let's look at the red flags, the bear case here, because it's not all sunshine.
That's it.
Their legacy automotive segment actually declined by 7%.
Right, which is a drag on the overall business.
So TTMI is basically a restaurant where the new AI-themed tasting menu is sold out every night.
Right.
But nobody is buying their classic automotive cheeseburger anymore.
That is a great way to put it.
Is that enough to sustain the hype? I mean, if the AI narrative is so strong, we need to look at what the people closest to the money are actually doing.
You've got to follow the money. Insider and institutional flows.
Exactly. And this is where it gets highly complex. I was looking at the data, and CEO Thomas Edvin just sold roughly 1.68 million shares.
That is a massive block.
Right. He sold them at $100.23 on April 1st.
Interesting timing.
And overall net institutional purchases actually decreased by about 4.88% in the latest reporting period.
Okay, but you have to look at the daily tape here. Because on April 10th, the order flow shows this massive volume spike.
How massive?
3.06 million shares traded, which is well above their 2.19 million average. And that volume happened right at the top, at the $121 to $123 level.
Wait, here's where it gets really interesting, though. If the stock is going to the moon, why is the CEO cashing out at $100? If the captain is taking a lifeboat, shouldn't retail traders be worried?
Well, insider selling doesn't always mean doom. Executives diversify for tax reasons, estate planning, all sorts of things.
Right, yeah.
What is truly fascinating here is that despite the CEO selling and that slight dip in overall institutional buying you mentioned, that massive volume at the current 121 to 123 levels suggests heavy institutional accumulation is still happening right now.
So big money is stepping in to absorb those shares from the CEO.
Exactly. They are buying the top.
Okay, so with big money fighting over shares at 121, we need to look at the technical charts and the valuation metrics.
We really do, to see if retail investors buying today are getting a deal or getting trapped.
Let's break down the technicals. The trend is undeniably bullish.
Oh, absolutely. The moving averages are all pointing aggressively up. It's trading well above its 5-day moving average, which is at $121.46.
Right. It closed at 121.24, so just barely under that 5-day.
Exactly, but it's massively above the 50-day at $102.70, and it's miles above the 200-day at $98.85.
So where is the resistance overhead?
The key immediate resistance is that recent high of $123.16.
Okay.
And that aligns closely with a Fibonacci pivot point right around $122.60.
And if it gets rejected there?
Immediate support rests at $107.91, with a massive absolute floor way down at $83.82.
Which is a huge drop if it falls through. What are the analysts saying?
Analysts give it a strong buy, 4 out of 4. With an average price target of $121.80 and a high target of $135.
And the momentum indicators?
The MACD is sitting at 5.70, which is a strong buy signal. But
at the RSI?
Yes, the 14-day RSI is screaming at 79.06.
Wait, 79? That's extreme overbought territory.
It is extremely overbought.
And this brings me to the absolute core of the value trap debate. The PE ratio.
Let's hear it.
The trailing PE ratio is a sky-high 71.9.
That is steep.
Right. The 5-year median is only 28.6, and the industry average is around 31.6.
Yeah, that is more than double the norm.
So this looks like a classic value trap for retail traders who get FOMO and buy at the absolute peak of the roller coaster. I mean, buying a hardware company at a 70x multiple.
If you are looking backward, yes, but you have to look at the undervalued perspective here.
Okay, convince me.
While the trailing PE is 71.9, the forward PE is estimated to be around 5.62.
Wait, really? 5.62?
Yes. When you factor in their massive long-term growth, that RTX contract, the new capacity, If AI demand continues at this pace, the stock is actually incredibly cheap right now.
Wow. So the big funds are buying at 121 because they believe in that forward multiple of 5.
Exactly. They aren't looking at the past.
So synthesizing all of this for you listening, trying to figure out the short-term versus long-term outlook.
In the short term, you really have to respect that extreme overbought RSI of 79.
Right. It suggests a high risk of a minor pullback, or at least some consolidation.
Definitely. The downside risk is very real for retail traders buying right at the top, especially if it drops back to test that support at 107.
Nobody wants to buy at the top and immediately ride it down 15 bucks.
No, but long term, the trend remains powerfully upward heading into their April 29th earnings report.
So it all hinges on that earnings call.
Pretty much.
Well, TTMI has proven it can ride the AI wave in defense spending all the way to a 545% return.
They've executed brilliantly so far.
But with earnings looming on April 29th and this massive glaring gap between the trailing PE and the forward PE,
Yeah.
are we witnessing the birth of an industry titan or just a masterclass in market overreaction? I mean, what happens if the broader macroeconomic AI hardware cycle cools down next year?
That is the million-dollar question.
Right. They just drain their free cash flow to build massive physical infrastructure. If the broader market decides we've overbuilt data centers, TTMI could be left holding massive empty factories for a gold rush that has already peaked.
It's a huge structural risk.
That is for you to decide. Thank you so much for joining us on this deep dive into TTMI.
It's been a fun one.
Absolutely. And remember, please like the video, subscribe, and drop a comment down below. Are you buying into the hype or staying away? We will catch you on the next one.